What's up traders, welcome back. Today I'll be showing you how I managed to take this Nasdaq sell setup using only market structure. No order blocks, no fair value gaps, no indicators, only market structure. So now let's look at how I see market structure and how you can take advantage of it and not being caught on the wrong side of the move or not being confused by the noise on the lower time frame. So we'll be looking at market structure breaks and correct retracement, the only retracements you should consider. And we'll be looking at fake outs, which are turtle soups or stop hunts. We'll also be looking at market structure shifts, which are reversals. So let's look at the first condition. We have price coming from the low, forming a high, with a new low, forming a higher high, a higher low, higher high, a higher low, and finally we have a higher high. So every pricing, so every time price trades above a swing, we know it's a market structure break, which is very easy to see. So this applies to a downtrend too. We have price coming from the high, forming a lower low, a lower high, a lower low, and so forth, lower low, and finally we have a low. So we understand that every time price trades below a swing low, that's a market structure break, right? So now, if this is so easy to see, what makes market structure so confusing for people? This is straightforward. Let's see why. So we have our bullish trend with our market structure break. So now, how would you know that we have a valid retracement? You want to have price retracing back to at least 50% of the range from the high to the low of the entire push, right? It applies for every push. You want price to return to at least 50% of the push. So now I want to demonstrate why that's important. So we have our two impulse pushes. So let's see what happens on the lower time frame and what makes people get caught up on the wrong side of the market or thinking that the market is reversing. So now we're going to replace these pushes with a lower time frame, right? So we're going to see what happens on the lower time frame while price is pushing higher and why you should only consider 50% retracements as a low or a swing low. So you have price pushing higher towards the market structure and finally breaking the structure, right? We have a retest for people who trade support and resistance. That's a retest of a support. We have price trading below that support, but keep in mind from the low to the high, it's still not at 50%, right? So this is what happens to people, right? This becomes liquidity and price pushing higher, right? We have a retracement, a push higher, and keep in mind your entire range now starts from the low to the current high. As long as we do not retrace back to at least 50%, your range is going to become bigger. You're still going to frame your Fibonacci from the low to the current high, which is where the price is right now. We have a liquidity sweep again, and finally closing a high. We have retracements, pushing lower, another liquidity sweep, but now price is at the 50% of the range. So when you're at the 50% or below, you can now consider price forming a swing, which is a higher low, right? So now price taking liquidity out. And also this is why I say every strategy works, right? You have a market structure break which forms a support. For people who are trading support and resistance, if they would buy in this range, they will be fine. if for people who are using order blocks, if they would buy in that range, it'll also be fine, right? So now we have a low, a higher high. Now we're at the higher low. So now we have a potential swing low. It can go lower, but at least the only swings you should consider are those that are at the 50%. Otherwise, you're gonna get liquidated. So we have price pushing higher and forming consolidations, whatever flags, bullish flags, I don't know what these things are called, I don't use them. We have a liquidity sweep, a push higher, breaking structure. So now with this, you want to see a retracement to the 50% of the range from the higher low to the current high. Otherwise, you do not consider price a retracement, or you do not try to continue buying. Otherwise, you are taking a risk with price retracing, but it's still not at the 50%, and finally trading higher. So now that's how price is gonna move. So the next thing, you would want to see price coming back to at least 50% of the range from the higher low to the higher high. And coincidentally, you'll see that the 50% is also where the market structure break was, which makes it a support, right? So you don't just use levels, like I say, you use reaction of levels. So let's look at the last condition. We have a bullish trend, the very same bullish trend we have, but now we have a market structure shift, breaking the higher low this time. We have market structure breaks, trading higher, and now this is a market structure shift. So now with this, we have a potential reversal. So you would want price to come back to the 50% of the new range to trade lower. But now the only way to confirm if a trend is really changing, or if it has really changed, if it's gonna hold, is if you would have a market structure shift and a market structure break. So you want price to break twice for you to consider it a change of a trend, right? Yes, so let's look at how I took today's trade using the same concept. So we're on Nasdaq. So let's see how I frame this sell setup using market structure only. So firstly, we have to identify the noise and the market structure. So understand we're coming from a low right there, pushing higher, we form the high, a retracement below 50% of this range. We have a market structure break. I'm only going to identify the structure first, and then I'm going to show you the noise. We have a high, break of market structure. We had a retracement inside of the 50%. Another break of structure, a retracement, and finally the last break of structure, right? So with this we understand coming from this price point, we had a push up, a retracement below the 50, right? And then we had a push up to this point, but this level did not take out major structure. So this can be identified as noise. So anything going down in this region is to get you confused. So we understand we push price, we retraced, now we pushed higher, we didn't take out this, so this is not a retracement. It's just a consolidation and causing confusion. We're breaking structure to the downside. So now if you're gonna identify this as a break of structure to trade down, you're gonna get caught on the wrong side. So we pushed higher, breaking this structure right there, and we had a retracement trading through all of this, breaking structure, major structure right there. We had a retracement and a push down. Now this is also noise right there, all of this. So we had a push up, trading down, but we had consolidations, breaking up, but we have to remember that now we are bearish. So we are bearish until we trade past that level. In this section, we are bullish until we trade past this level, right? So now if I remove this, we can see that using our Fibonacci, with a push from this low to the high, a retracement below the 50, which makes this structure valid. And then now we had a retracement, a push from the low, from this low, but now we had a market structure shift, right? So now we have a new range. So our new range is from here to here. We had a retracement above the 50, so this is valid. Now we had a push down to break structure right there. So breaking structure to the bottom, we had another retracement. So now we move from this high to the new high, which is this one now, and our new low is this one. So we want to see a retracement above the 50. If we have that, that's when I took a sell, because we are above the 50 inside of this impulse swing. So that's when I took the sell. I targeted this low. So when I bring back my chart, you can see it right there. So all of this is to confuse you. It's accumulation. They doing a lot of things, liquidity, accumulating liquidity. So now we can also see that like we have liquidity above these price points. That's what happened right there. But like I said, I didn't consider a lot of things. I just placed my pending order above these highs because I understood it was above the 50%, and then my stop loss is above my Fibonacci, which was from there to the low. I have a retracement into premium, sold to discount this low, then I'm out, right? So yes, so if you were late for bonus, you could use, if you missed that entry, you could use this high to this low. You understand that this is not above 50, so you can't sell. So now where's your new low? Your new low is there. So now when this came above 50, that's where you were supposed to sell and target this low, right? But now this is outside the trading times, right? We only trade New York. I don't think you should trade London because Nasdaq moves during New York session. So yes guys, that's it for this video. So if you have questions, be welcome to leave your comments in the comment section down below, and please leave a like and share for the YouTube algorithm. So see you on the next video. That was Vedania.